Hello everyone, welcome back once again. In today's video, we are going to solve two questions, Port and Starboard Company question and hide and seek question. Before starting the video, I would request you all to please like the video and subscribe to the channel if not, as it motivates me to post more useful content, right? So let's get started. So the first question is Port and Starboard Company question. So the statements of financial position for Port and Starboard as at 31 December 2006 are presented below. So this is our year end. Okay, fine. So now we have been given the current assets, non-current assets, equity, liability, okay. And then we have been given information. So let's just take a glance at it. So they have told that Port acquired 80% ordinary shares for 3 lakh. Okay, this is the purchase consideration on 1 January 20x2. Okay, which means that acquisition has taken place several years ago. At acquisition date, they have given us the retained earnings of Starboard, fine, and they have given us the fair value of NCI of Starboard, which was at 80,000, okay. Then we have been given certain adjustment about fair value of net assets. We know that we have to take fair value of all the net assets at the date of acquisition, okay. This is the rule. Upon consolidation, we have to take fair value of net assets of the subsidiary company, okay. Fine, we'll come to this afterwards. Then we have been given information about intra-group trading. So Port, which is the parent company, has sold goods to subsidiary company for 50,000, making a GP margin of 25%. Okay, fine. We'll come to this afterwards when required. First, let's see the first requirement. So the first requirement says that select the formula which correctly calculates goodwill on acquisition of Starboard. Okay, so let's see. I'll write over here. So the formula of goodwill is purchase consideration plus fair value of NCI plus, minus net assets of S at acquisition, right? So we just saw what was the purchase consideration. These both things are directly given. So let's note them here. So the purchase consideration was 3 lakh and the fair value of NCI is 80,000, okay? So over here, write down 3 lakhs. And over here, write down 80,000. Okay, so these two things were directly given. Now we have to do calculation for net assets of subsidiary at acquisition. Fine. So this would include the share capital. This would include share premium, retained earnings, and any fair value adjustment. Okay. All this information would relate to S company because we are acquiring subsidiary company. Okay. So let's see what's the share capital of S company. So the share capital is C 60,000 and share premium is 10,000. So let's quickly write over here 60,000 and 10,000. Now retained earnings. We have to take retained earnings at the date of acquisition. These retained earnings are the closing retained earnings, okay? Because we have been given balance sheet at 31 December. So we will not take this, but we will look for the information given over here, okay? See, we have been given here that at the acquisition date, the retained earnings of S company were 1,50,000. So over here, I'm going to write 1,50,000. Fine. And fair value adjustment. Now see, they have told that there were the carrying amounts were same with the exception of a plot of land. This land was recorded in financial statements at its cost of 150 but was estimated to be fair at a fair value of 180. Okay, so the cost was 1,50,000 but its fair value was 1,80,000. So what's the increase? The increase is of 30,000, right? 180 minus 150, the increase is of 30,000. So we will take this increase as our fair value adjustment and we will add it over here, right? Now let's move on to seeing the options which were given over here. Okay, fine. So in all the three options, we have 3 lakh and 80,000 which we have to plus. Now let's see minus things. So see, we have to subtract 60 plus 10 which is 70,000, right? So see, over here we have been given 70,000. Then we have to add the retained earnings which is 1,50,000 and we have to add the fair value adjustment as well. In this option they have deducted, so that's why we are going to ignore this. In this we will ignore this as well because they have just taken share capital and not taken the share premium. Okay, so I'm only left with option number 2. So this is my correct answer. Okay, let's move forward. Identify which of the following would be the correct classification for goodwill. So we know that goodwill is an intangible non-current asset because we cannot touch goodwill. Okay, so that's why it's not tangible, it's not a current asset, it is an intangible non-current asset. Fine, let's move forward. Now complete the following table to state at what amount each of the following items should be included in consolidated statement of financial position. Fine. Now we have to tell that at what amount we are going to record our PPE. So this would be the property, plant and equipment of the parent company plus the property, plant and equipment of the subsidiary company, and to this we are going to add the fair value adjustment because we have to record land at its fair value. Okay, so we are going to take the increase. We have already included the land at its cost over here. Okay, so in order to include it at its fair value, I'm going to add the fair value adjustment, okay, which was 30,000 increase. Okay, so 3,50,000 plus 2,65,000 plus 30,000, the answer would come out to be 6,45,000. And because over here I have been given the answer in 3 zeros, so I'm just going to write 645. Okay, I hope you have understood why we have added 30,000 over here, because we have to record the assets at their fair value. Okay, the cost was 150, but I have to record it at 180. Okay, I have recorded at this amount. So in order to record it at this amount, I will add 30,000. So that's why I have added 30,000 over here, right? Let's move forward. The next requirement is to find the amount of inventories. Okay. So whenever we have to find the inventories, we have to adjust it for any unrealized profit. Okay, and we know that here certain sale has been made, intra-group sales has been made, so we have to adjust our inventory for it. So see, inventory, we will add 1,09,000 and we will add 80,000, and now let's see the unrealized profit adjustment. So Port has sold goods to Starboard for 50,000, making a GP margin of 25%. So see, P has sold to S, making a GP margin of 25%. And what was the selling price? Selling price was 50,000. Selling price, or I can say the sales is at 50,000, and GP is always on sales only. So I'm going to directly calculate my profit. The profit which P has made is 50,000's 25%. So this will come out to be 12,500. Okay. Now, my unrealized profit would arise on those goods which are still held in inventory. 60% of the goods had been sold by Starboard. So if 60% are sold, so how much are left? 40%. It means that S still holds 40% of the goods. Okay, so my unrealized profit would arise on these 40% goods which have not been sold. So calculate 40% of 12,500. So let me calculate it quickly. 12,500's 40% is 5,000. Okay, so this is my unrealized profit and I'm going to deduct it from my inventory. So from here, deduct 5,000, right? So when you'll make these adjustment, you have to add 1,09,000 plus 80,000 less 5,000. So your answer would come out to be 1,84,000. Okay, so I'm just going to write 184 over here because my answers are in 3 zeros. Fine. Now let's see for trade receivables. For trade receivables, I'm going to add the 79,000 and I'm going to add 95,000. Okay. Plus C over here, read this. At reporting date, Starboard still had a payable due to Port for 30,000 and this agreed with the receivables recorded in Port's accounts. Okay, so see, this is the group in which there is a parent company and there is a subsidiary company. Now subsidiary has to pay 30,000 to Port company and Port company has to take, so see, in subsidiary companies, this is a trade payable, okay, because they have to pay to P company, and in books of P company, this is a trade receivable. But from the point of view of a group, this is a one company only, okay? Both these companies P and S are one only, okay? So it means that we are just transferring from one pocket to another pocket, okay? It will not make any difference, so that's why we have to eliminate this. Okay, it is just a transfer from one pocket to another pocket, so that's why we are going to eliminate it. Okay, so from your trade receivables, deduct this 30,000. So from here, I'm going to deduct 30,000, right? So after doing this, my answer would be 1,44,000. So I'm going to write 144 over here, ignoring the 3 zeros. Fine. Similarly, for trade and other payables, add both these figures and deduct 30,000. Because in books of S company, it is a payable, okay? And here in the books of P company, it is a trade receivable. So from both these things, we will eliminate 30,000, okay? So you will get your answer as 1,85,000. So I'm going to write 185 over here, okay? Last is 7% bank loan. So we have not been given any adjustment for bank loan. So simply add both these figures of 3 lakh, see over here bank loan, 3 lakh plus 85,000. So answer would be 3,85,000. So just write 385 over here. Fine. Okay, let's move on to task 3. What amount should be included in consolidated statement of financial position for NCI as at 31 December 20x6? Fine. Let's see. So in our statement of financial position, NCI would be recorded at its fair value of NCI. And then we are going to include NCI's share of profit. Okay. So we know what is the fair value of NCI. It was given directly in the question. It was see 80,000. Okay. So over here, I'm going to write 80,000. Now look at this very carefully. Our closing retained earnings were 2,50,000. Now see, first understand that we are calculating NCI's share. So this is a subsidiary company which is owned by parent company and the remaining share is of NCI. Okay, so that's why while calculating NCI, we will look at subsidiary company's profits. Okay, so the closing retained earnings of subsidiary were 2,50,000. Okay, and the opening, which means when the subsidiary was acquired, it was 1,50,000. If I have to draw a timeline over here, so the closing retained earnings are 2,50,000 and the opening were 1,50,000. So what would be the profit? Profit would be the movement, okay? The movement from 1,50,000 till 2,50,000. So what's the profit? 2,50,000 minus 1,50,000. So the difference is coming out to be $1 lakh, right? And NCI would have a share of 20% in this because parent owns 80%. So the remaining 20% is with subsidiary company. Fine. So this will come out to be, let me calculate it, 1 lakhs 20%. So this is 20,000. Okay. So we are going to add both these. So my answer would be 1 lakh. Okay. I took the fair value of NCI. This was directly given in the question. And now I have to take NCI's share of profit. For this, I deducted closing retained earnings from opening retained earnings in order to get the profit figure. Okay. The movement in the retained earnings is the profit figure. And I have multiplied it by 20% because that's the share of NCI. So this is coming out to be 1 lakh. So let's write our answer. So here we'll write 1 lakh. Okay. Let's see the second requirement, which is consolidated statement of financial position retained earning. Okay, so we have to tell what is the amount of retained earning which will appear in statement of financial position. Okay. So this would include retained earnings of P company, retained earnings, not the retained earnings, profit of S company, and we will take 80% of it because P company owns 80% of it. And from this, we are going to eliminate our URP, which is the unrealized profit. See here, the parent company is the seller and subsidiary company is the buyer. So with whom the profit is lying? Profit is lying with the P company because P company has sold goods to S company at a profit. Okay, but this is now an intra-group trade from the perspective of a group. These are one company now. Okay, so selling goods to P at a profit does not make any sense. So from profits of P company, we are going to eliminate our unrealized profit. Okay, so let's see what are the retained earnings of P company. This would be directly given in the question. So here are the retained earnings of P company, 2,95,000. Okay, 2,95,000. Now similarly, like we did above, here we found that the movement was 1 lakh. Okay, this was the profit. And for the NCI, we multiplied it by 20%. And for our consolidated retained earnings, I will multiply it by 80% because if 20% belongs to NCI, so the remaining 80% would belong to the parent company. Okay, so multiplied by 80%. Yeah, 80%. Okay. Yeah, fine. And the unrealized profit was 5,000. Okay, we calculated it above. I'll show you. See, this was the unrealized profit. So let's see what will be the final answer. So when you'll make this adjustment, this would come out to be 80,000. So add. Add this, and we are going to deduct 5,000 from this. So let me quickly calculate this. 2,95,000 plus 80,000 less 5,000. So this is coming out to be 3,70,000. Okay. So let's write over here 3,70,000. Okay. Next. Port is considering making an investment in another entity which could be accounted for an associate. Which two of the following factors would be relevant when accounting for associate? So when we make accounting for associate, it gives us significant influence, not control. Okay, so this is not the answer. Exercising significant influence over Aston, so this is correct. Okay, associate accounting gives us a significant influence and not control. Okay, owing majority of ordinary shares, no. This happens when we are acquiring a subsidiary. Okay, when we acquire a subsidiary, then we own majority of shares. Then owing between 20% and 50% of ordinary shares, that's right. Because when a company acquires, suppose 31% share, then we say that it is an associate investment. Okay, so the holding should be between 20% and 50%. Then accounting for goodwill, no. We never calculate goodwill upon doing associate accounting. Accounting for NCI, again, no. So our correct answer is 2 and 4. Okay. Then next question. State which of the following are true or false. If gross profit margin of a business improves, then current ratio will also improve. This is false because GP and current ratio does not have any link, any direct link. Okay, so we cannot say that if GP is increasing, our current ratio will also increase. It might happen that our current liabilities might increase. Okay, we might make say we might have purchased goods on credit, so that's why it may increase our current liability. Okay, so we cannot say that there is any direct link between GP and current ratio. So this is false. Okay. If a bonus issue of share is made, this will have no impact upon current ratio. So this is true because when we issue bonus shares, these are free shares, okay? And we do not get any cash for them because these are free shares. So that's why it will not have any impact on our current ratio also. Fine. I hope it's clear with you now. Let's move on to the 15th question, which is hide and seek company question. So now this is a question of consolidated profit and loss. Earlier one was consolidated financial position. This is consolidated profit and loss. So we have been given the year end is 30 June 2086. So keep this in mind. Let's change the color of the pen now. Okay. First, let's quickly see the requirements. Okay, we have been given a lot of information, but let's first see the first requirement. We have to calculate goodwill. Okay, the first thing which we have to tell the cash paid. Okay, so let's start by reading the first note. Hyde acquired 3 million of $1 equity share of SEEK on 1 April 20x6. So see, this is our timeline. The year end is 30 June 20x6. So the year start would be 1 July 20x5. Okay. So the acquisition has taken place mid-year, which is on April 1 April 20x6. Fine. When SEEK had a total of 4 million equity shares paying $8 per share. Now, understand what's happening over here. We are doing question number 15. So, the SEEK company has total 4 million shares of $1 each, which means that share capital is again $4 million only. Okay, 4 million into 1, it is $4 million. Hyde company has acquired 3 million shares. How much has the Hyde company acquired? 3 million shares. It means that remaining 1 million belongs to NCI. Okay, out of the total 4 million shares, 3 million have been acquired by Hyde. So the remaining 1 million is acquired by NCI. Okay, now let's calculate the percentage also. So 3 million shares have been acquired and the total were 4. So I'm going to write it in denominator, multiply by 100. And over here, NCI has 1 million shares, total were 4, multiply by 100. Okay, so this is 25%. NCI has 25% share and the parent company has 75% share in the subsidiary company, which is SEEK. Okay. Now they have acquired this 3 million shares by paying $8 per share. Okay, how much have they paid? $8 per share. So multiply it, you will get 24 million. Okay, each share is of $8. Okay, they have given, what has happened? For every share, they have given $8. Okay, and how many shares have they acquired? They have acquired 3 million shares. So multiply it by 3 million. So the answer would be 24 million, right? So over here, in our cash paid, I'm going to write 2, 4, 3 times 0. See, 24 million means 2, 4, 6 times zeros. Okay, I have to ignore 3 zeros because I have been given this in question. So that's why I'm going to write 24,000. Fine. Let's see now the fair value of NCI at acquisition. Okay. Let me highlight this, that this is 75% and this is 25%. This is P company's share and this is S company, NCI's share. Okay. Now we have to tell the amount that belongs to NCI. See, over here, they said the fair value of NCI interest in SEEK at the date of acquisition can be measured by reference to fair value of SEEK share at 1 April, which was $4. So, one share is $4. For valuing NCI, we have to take the reference that one share is of $4. NCI has 1 million shares. NCI has 1 million share and each share is of $4. It means that total fair value of NCI is $4 into 1, which means NCI is worth $4 million. Okay, because shares were 1 million and each share was of $4. So over here, I'm going to write 4,000. Again, 4 million means like this. Ignore 3 zeros. So what's remaining? 4,000. Fine. Now let's see the fair value of net assets. The first one is share capital. So see, share capital, I told you earlier only that C company has 4 million share and each share is of $1, which means that share capital is 4 million. So over here, write 4,000. Okay. Now let's do the adjustment for retained earnings. Okay. Retained earnings. Where have we given? Where is it? Let's find. Okay, we have been given here in point number 2. See, at 1 July 20x5, the retained earnings of SEEK were $9.5 million and the carrying amount of the net assets SEEK approximated this. Okay, so we required this afterwards. So we will read it afterwards only. First, let's do the adjustment for retained earnings. So the opening retained earnings were 9.5 million. See over here. This is my year. Over here, the retained earnings are 9.5 million. So I can write them as 9,50,000. Okay. No, wait. This would be 9.5 and like this would be okay. So these are my opening retained earnings, but I have to take retained earnings at the date of acquisition. So this was my date of acquisition, which was 1 April. 1 April was my date of acquisition, and this date is 1 July. So calculate how many months are these? July, August, September, October, November, December, January, February, March. Okay, till March, because this is 1 April. So these are 9 months. Okay, so in order to calculate my retained earnings at 1st April, what I'm going to do to this figure, I'm going to add profits of 9 months. So see, what were the profits? Let's see. We will find it over here. The profit was 14,000. Profit for the entire year was 14,000. So the profit for 9 months would be 14,000 9 by 12, right? So let's calculate this. 14,000 9 by 12. This is coming out to be 10,500. Okay. So over here on 1 April, my retained earnings are going to be this 95 lakhs plus 10,500. Add them. Let's see what's coming out. Just a second. I think I've made a mistake of zeros over here. 9.5 million. Oh, this is fine. Okay. This would be also in 3 zeros, right? Or let me do from here, let me eliminate 3 zeros, okay? Because I have taken this amount of 14,000 by ignoring the 3 zeros, because over here I was given that 3 zeros have been ignored. So from here also, let me ignore the 3 zeros. So just add 9,500 and 10,500, okay? So this is coming out to be 20,000. So over here, we'll write 20,000. And how did I get it? I have to choose from here. So I took 9,500, okay? Because see, these three, we have been given the figures in 3 zeros. So 9.5 million means, see, I'll tell you, it means like this, okay? So we have to ignore 3 zeros. So what's left? 9,500. So 9,500 plus we are going to take profit for 9 months. And we will take 14,000 9 by 12. So this is the correct answer, okay? Let me repeat quickly. We have been given the opening retained earnings and we have to find the retained earnings at acquisition. So to my opening retained earnings, I will add the profit, okay, which has been earned from 1 July till 1st April. So these are 9 months. For the whole year, the profit is 14,000. So for 9 months, it would be 9 upon 12, which is coming out to be 10,500. Fine. Okay. Now we have to tell the fair value adjustment. So here it was given. The carrying amount of net assets of SEEK approximated to their fair value with the exception of land and building, which had a fair value of 2 million in excess of their carrying amount. So we have been directly given the difference that the fair value is 2 million higher. Okay. So I'll directly write over here 2,000. Okay. I have ignored the 3 zeros. You know why? Because over here I have been given everything in 3 zeros only. So now what would be the goodwill? We have to choose from here. Goodwill will be the fair value of consideration paid plus fair value of NCI plus fair value. No, we do not add the fair value of net assets, we deduct them. So fair value of consideration paid plus fair value of NCI minus fair value of net assets. So this is the correct option. Okay, fine. Now let's do this. We have to calculate consolidated revenue. Okay, consolidated P&L it is. So we have to calculate consolidated revenue. So see, over here, we will take entire revenue of our Hyde company, which is 2 lakh, right? But be very careful that we cannot take entire revenue of our Seek company because we have acquired it mid-year, okay? So, what were the post-acquisition months? From 1st April till 30 June. How many months it would be? April, May, June, 3 months. Okay. So we will only take 3 by 12 of our 1 lakh. Okay. So add them both. Let's also see if there is any intra-group trading because then we have to eliminate it. Yes, we have. See, point number 4. During post-acquisition period, Seek sold goods to Hyde. The goods originally cost 10 million and they were sold to Hyde at a markup of 25%. So the cost was 10 million. Okay, so I'm writing 10,000. I'm ignoring the 3 zeros. I'm writing 10,000 and they were sold at a markup of 25%. So now we have to calculate the selling price. See, in all the previous questions which we have done till now, they had given us the selling price, which was the sales revenue. Okay, that's why we used to calculate it by let the cost be X. Okay, we used to do this thing. But now in this question, we have been directly given the cost and we have to find the selling price or the sales revenue. So what I'm going to do to my cost, I'm going to add this markup, which is 10,000 25%. So when I'll do this, I'll get my sales, okay, or the selling price. So this will come out to be 12,500. So my sales are 12,500. So these are intra-group sales, okay, from subsidiary company to parent company. It is happening between the same group only. So that's why I will eliminate it. So over here, I'll add 2 lakh. I will add 3 by 12 of 1 lakh and I will deduct 12,500. Okay. And when I'll do so, my answer would come out to be 212,500. Okay. So I'll write over here 212,500. Next, cost of sales. Again, see from cost of sales, what are we going to do? I will add this. Again, I will take 3 by 12 of this. Okay. One second. Yeah. I'll take 3 by 12 of this. Now again, I'll deduct 12,500 from here, which are the intra-group sales, and I will add my unrealized profit. Okay. Why do I add this unrealized profit? I add this in order to increase the cost and eliminate the profit thing. Okay. So what's my unrealized profit? For this, I have to read the question further. By 30 June, Hyde had sold 60% of the goods. So my unrealized profit will arise on the goods which are unsold. So how many goods are sold? 60% are sold. It means 40% are unsold. First, tell me what is the profit figure. Profit is goods were sold for 12,500 and their cost was 10,000. So profit was 2,500. So my unrealized profit would be 40% of 2,500. Okay, because my unrealized profit only arises on unsold goods. Okay, so profit was 2,500. Calculate 40% of this. Let me do it. So this is coming out to be 1,000. Okay, so I'm going to add 1,000 over here. Okay, so let's see what's the answer coming out to be. It will come out to be 1,11,000. Okay, 1,11,000. I have to choose from the options. So I will take 1,10,000. To this, I'll add 3 by 12 of 50,000. Okay, fine. Then I remove 12,500. So either it would be first or second. Ignore the third one, okay? Because I have to eliminate the intra-group sales. And then I add the URP, which is 1,000. So my answer is this second one. Okay, fine. Let's calculate the next amount, which is our distribution cost. So simply take 20,000 and take 3 by 12 of 10,000. Okay, because see, there is no adjustment for distribution cost. Only these were the adjustments given. So now we just have to add them and take 3 by 12 of my distribution cost. So when I'll do this, my answer would be 22,500. So over here, for my distribution cost, it would be 22,500. Similarly, we will calculate for administration expenses and we will calculate for income tax expense also. So 40,000 plus 20,000, 3 by 12, and for taxation 10,500 plus 6,000 and take 3 by 12 of this. Okay. So let's see. I'll write the amount for both these. So my administrative expenses would be 45,000. Okay. And obviously I'm going to deduct all these because these are the expenses, and my tax expense would be 12,000. The only tricky thing here was the revenue and the cost of sales. For rest of the things, we just have to add, okay, and take 3 by 12 of subsidiary companies figures, okay. Now we have to tell the non-controlling interest, NCI, and we have to choose it from the options, okay. So let's see. Non-controlling interest share of SEEK's profit for the year minus provision for unrealized profit. No, see, we are going to take NCI will have share in the post-acquisition profits. Okay, so NCI's share of interest of SEEK's post-acquisition profit, fine, plus NCI interest share of URP. No, we deduct it. I will explain you. See, now in this question, what has happened? This was the parent company and this was the subsidiary company. So subsidiary company has sold goods to the parent company, which means that subsidiary is holding the profit. Okay. Who has profit? S company has made profit by selling the goods to parent company. Now this S company is owned by the parent company and NCI also has a share in this S company. So NCI will also have share in the unrealized profit. Okay, so remember, whenever there is S2P sales from subsidiary to parent, so unrealized profit would lie in NCI also. Okay, so we have to reduce NCI's share by the URP figure. So my answer would be NCI interest of SEEK's post-acquisition profit minus NCI share of URP. And I'll tell you how will the calculation take place. So what was the profit figure? See. The profit of S was 14,000. So I will write 14,000. And what is NCI's share? NCI's share is, I calculated at 25%. Okay, and we will take 3 by 12 of this because this is the post-acquisition period. I'll show you. Wait. See over here. I solved it that NCI has 25% share. Okay, so I will take 25% of 14,000 and then I'll take 3 by 12 of it. Okay, now what was the unrealized profit? I have calculated that too. My unrealized profit was, I guess, 1,000. Yeah, it was 1,000. So NCI will have a share in this too. So what will I do? I will take 1,000 and I will take 25% of it and I will deduct this amount. Okay, and I will add this amount. So that's how I will get my NCI figure. Let me calculate it. So this would be 875 and this would be 250. So my final answer would be 625. Okay. Let's move further. I guess we are left with only 1 or 2 requirement. We have done all this. Okay, fine. Last requirement. Based upon individual financial statement of Hyde and Seek, Hyde has a lower GP margin than Seek. Which of the following could be an explanation for this situation? So the GP margin of Hyde is lower. Seek has lower level of inventory than Hyde at the start and end of the reporting period. So this is not an explanation because level of inventory cannot justify our gross profit margin. Okay. So Seek is able to purchase cheaper material and has a lower wastage rate of material than Hyde. Okay, so this can be an explanation because if Seek purchases cheaper goods, so its cost of sales would be lower, and if its cost of sales would be lower, then automatically its GP would increase. How does this happen? This is the revenue. From this, I deduct cost of sales and then I arrive at GP. Okay, so if my cost of sales would decline, so I will deduct a lesser amount. Okay, so that's why my GP would increase. So this can be a possible explanation. Let us read this one also. Seek has lower distribution cost and administrative expenses. This cannot be an explanation because distribution cost and administration cost are our indirect expenses and they impact the operating profit. Okay, they impact operating profit and not the gross profit. I deduct these expenses after calculating my GP. Okay, so that's why this cannot be an explanation. So my correct answer is 2. So we are done with both the questions. I hope you are clear with them, and still if you have any doubt you can ask in the comment section below, and I'll see you in the next video. Till then, keep studying. Thanks for watching. Bye bye.